Hello, everyone, and welcome to Wall Street Hackers Live on Pod TV with Peter Bennet, who received his bachelor's of economics at UCLA, a law degree at Miami, and his MBA in finance from New York University, where he also worked on Wall Street for almost 17 years. Peter is here with us to share with us some great tips of surviving this economic storm while investing and researching your stocks. Welcome, Peter.
Hi, Kim. Hi, everybody. So we'll get right into the markets. Thanks for the intro. First, we bring up our favorite chart, which we always love to bring now. And this just shows you whatever stock allocation you have. Everybody's has a different profile. So some people want to be aggressive in a lot of stocks, a high percentage. Some people want to own more bonds. It depends on your age. It depends on your, goals. Different people have aggressive to very non-aggressive profiles. But whatever stocks you want to own, dividend growers and dividend payers, based on history, are clearly the place to be. This is a 50-year chart to 2022 that shows how dividend payers and dividend growers far outperformed the equal weight S&P 500 by basically double. $100 only in 1973 grew to 4,000 in the equal weighted, 8,000 plus in dividend payers, and 13,000 in dividend growers. So that's, if any stocks I have, I'm looking for dividends, I'm looking for dividend growers. I am not going with an equal weighted S&P 500. And that's one of our main philosophies of our show. So if we can drop the chart, Kim, I'll talk a little bit about the markets and we'll get into other charts this week. So the Fed paused, and a lot of commentators said, why? Especially when they came back with a pretty aggressive message that they're going to probably raise rates 2 more times. So why pause? But it might have had to do with politics on the committee, that they wanted a unanimous vote. Whatever it was, the market took it as good news. It's anything they take as good news because it's kind of delusional. But as we said for a year and a half, Fed does not have inflation under control, and it looks the same as it does last year. I don't see huge differences in the numbers. Unemployment is very low at historic lows. Energy costs brought inflation down for a while. Now they're going to go higher in the summer, or at least they won't have comparisons to dropping energy costs, which help reduce inflation. So I don't see it. The Fed is probably going to keep raising. And if you don't go with that, we have a few other points here. But one, despite the happiness over the pause, yesterday, Fed Chairman Powell talked to Congress, and he said that in terms of inflation, in order to get to their target, that he has, quote, a long way to go. Well, 2 points. If it's a long way to go, that's not good for the market, but the market doesn't want to accept that. And 2, he doesn't even know how far it was. I mean, they were off so far, so long, and in expecting inflation and then in fighting inflation, it's been a year and a half. And who knows? I mean, historically, there's a lot of studies that show generally it takes 10 years to fight inflation. The market is not priced for that. So one more piece of news, and then I'm going to get into the markets themselves. But the United Kingdom just came in with an inflation rate of 10%. And that is a 30-year high. And I believe I heard today or yesterday that they just raised the rates on the euro in England. I'm sorry, in Europe, another 0.5%, I believe, but I'd have to double check that. But it's out of control everywhere. Why? Because of commodities inflation, because of all the 5 factors we talked about for a year and a half now. So, but let's pretend we're ignoring the Fed and inflation rates and look at what this market is, because some people say, well, look how great the market's done this year, although it's still down from what it was back in January 22. But it came back so far this year. And I would footnote that UBS is projecting it's going to basically lose it all by the end of the year, or JP Morgan is. So let's bring up 3 charts that show what I think is the reason why the market has been going up just this year. And I think it's very convincing when you look at this. So the first chart when you look at them as a whole. So the first chart is the market breadth has never been this narrow. So what it's saying is, if you look at since 1990, I know it's hard to read the years because the chart's a little small, but I'll work on that. But 1990, you could see the history since then, and right now, and so this is comparing the equal weighted S&P 500 versus the cap weighted S&P 500. What that basically means is tech and a very few companies are dominating. So the market may be up 13% or wherever it is today. It's been down 4 days in a row now, so I don't know exactly, but around there. But it may be up, but when you look at an equal weighted, in other words, if you look at the whole S&P 500, most of the companies are down about 10%, and that is historic in terms of since 1990. It's never been that unequal where only a few companies are carrying the water for the whole market. Now, number 2 chart, if we can bring that up, S&P 500 for companies citing it, AI. So again, sorry, it's hard to read. I'll work on that. But this is a chart of the S&P 500 companies that are citing AI on the earnings call. And you could see it's dramatically increased. This is the thing these days, just like, the fad of the day. Or I misstated that. I mean, it's an important change that's coming. And AI is important. But the thing is, what this tells you is what I said last week. AI is not a secret. These companies are priced for a lot of growth. And we're going to see that in a minute because the third slide is the most important one, I think. So you're talking about now, out of the S&P 500, in the last quarter, 110 were talking about AI. So yeah, AI is great and it will change things, but it's not a secret. And the market is always pricing in the existing information. At least that's what the efficient market theory says. And most times that's true. So AI isn't a secret, and that's the point. But this is the key chart that reinforced what I was talking about last week, and then I saw this chart. So let's bring up the Microsoft chart. Good. Okay. Again, it's hard to read, sorry, but this is a chart in the bottom. You'll see dates from 2016, basically yearly until 4/23. And what this is this is for Microsoft, but it's very indicative of a lot of the tech companies, but it's price correlated with adjusted operating earnings. So the market often generally values companies on their current earnings and future earnings. So you could see until about 2020, the market priced it at about at the same ratio to their current earnings. But then in 2021, it started jumping way ahead of its earnings ratio, but then it fell back down. So that's interesting. And now for the second time since 2016, it's jumped up almost as much as it did in 2021. So I'm not against tech. If there was one more sector I might take a chance on, if I wanted to be speculative, it's tech. Because if you hold it long enough, maybe the growth will overcome interest rates, the economy. These are great companies. But as I pointed out last week on a different company, NVIDIA was 157 times cash flow, whereas the market itself, the S&P 500, is 14 times. So NVIDIA has to grow its cash flow by 10 times. That's a lot of growth for a big company. So I think the market is overdone. Nobody knows anything. Bitcoin just jumped again, but to me, it's insane. But it could go to 1 million or 0, and the market can do the same. And you can just make your best calls. But I think the market is probably due for a big correction, and if not, it'll probably stay at best pretty level from here, because more and more reality will set in. People will refuse to sell; they'll just ignore reality because they don't want to be proven wrong, or because of the incentives of the institutions and brokers and mutual funds. So I just, bottom line, say be defensive. And the nice thing is, if you own end up this part on a positive note, the nice thing is, if you own dividend stocks, as long as they're safe companies, you're just getting the cash flow, reinvesting it, and you don't really care what the market is undervaluing or overvaluing. You're just staying with companies that are generating income for yourself, which I believe also will be extremely important in the future, not just for retirement in general, but also because I think down the road rates are going to go very low. and it'll be hard to get income in bonds or anything down the road, given the demographics and everything else of our societies in all countries. So, two quotes of the week, which obviously I picked quotes that reinforce what I believe, but to me it's pretty solid. So, number one, this is from Tuesday's Barron's Daily. House weathers interest rate storm, why it's a problem for the Fed's pal. The Fed decision to skip an interest rate hike last week left, I'm going to paraphrase a little, left many puzzled. Ostensibly, it was allow more time to wait, but at the same time, the Fed's own estimates of how high rates need to go this year has risen. If the forecast is right, why wait? They agree with me. Why did they wait? They've been too slow to begin with for a year and a half, and before that. The impact of rate hikes is indeed unclear, but if anything, it's surprising how little effect they've had. The housing market, for example, seems to have absorbed the blow without collapse. Buyers are coping with higher mortgages. Home builder confidence rose for the first time in 11 months. This is not a good sign for fighting inflation either. Unemployment is historically low, and purchasing managers index, while showing manufacturing is weak, also indicate services are humming along. This is not a we're winning the war on inflation story. Also, the other one is from Jeffrey Gundlach, very sharp, respected person on Wall Street in general, although so many are, but I mean, he's a big name on Wall Street. He's the Double Line Capital founder. He said, the stock market, frankly, is exhibiting signs of mania, where you have a very concentrated part of the market driving the entire train. So maybe I picked these because, I agree with them, but the other side is seeing them after I make the calls. So that's where we are in the markets. We're going to do something different on the 5 most interesting stories of the week. Every show we do 5, I think, very interesting stories, but this week we're going to have 2 panel discussions. And one reason is because one of the interesting stories of the week was just so interesting, and it requires a lot of depth about government censorship and also COVID. So we're going to cover that, and we're also going to cover the income stock of the week, income pick of the week in this case. And so we'll do a quick advertisement, and we'll be right back. See you soon.
Oh, beautiful for spacious skies, for amber waves of grain, for purple mountain majesty above the fruited plain.
Okay, we're back. So what to do, and that's the same as always. Be very defensive. Own dividend stocks for the stocks that you want to own, and especially own energy, which I say over and over again, because the energy is a big issue for inflation, but also because there's 40% too little capital being put in energy for years now, since 2015. So that's going to be a problem. These projects take 5 to 7 years. And if we don't have an energy crisis this year, which I don't think we'll have, next year, the year after, there's probably energy is going to keep driving inflation because there's a huge investment in energy. So the dividend pick of the week is actually an income stock of the week. It's a bond. I was going to talk about SRRTF. That's I'm sorry. Hold on one second. Cat, can you get them out of here? Hi, thanks. Nice job running the ad, Kim. I had some background sound that I just had to get rid of. So I was going to do SRRTF, which is Slate Grocery, one of my favorite companies, a very large allocation. I'm going to go into it more next week, but I really like this company. Even in this market, I like this company. And there's never a guarantee, by the way, especially I have to say for the radio view, our new radio listeners, there's no guarantees. This show is for entertainment only. Consult your financial advisor. These are just my opinion. So you go with them or not. But I love SRTF. I have a big allocation inside an IRA because it avoids, depending on your broker, it might avoid some Canadian taxes. But we'll get into that this week. So I was going to do that, but then just in this last day or 2 days, I found a Delaware municipal bond that is worth talking about. So I believe that interest rates are heading to zero in 5 to 7 years for about 3 reasons. AI is very deflationary. Demographics are very deflationary around the world. And also governments around the world have underfunded and non-funded all of their future liabilities for medical care, free care in other countries, for aging demographics, not the US government not putting any money away really for Medicare, which may go broke in 2028, and also underfunding of pensions and retirement plans around the world, including the United States, but also in Europe and South America. The whole world is just, okay, we'll handle it later, kick the can down the road. It doesn't work that way. So when they have so much debt that they're printing money because they won't be able to tax it to that much money, then the governments are not going to want to pay interest on the money. So what they're going to do is use yield curve control, which has been done in Japan and done in the United States in the past, to keep interest rates down to zero. So it's good to lock in long-term dividends. And also, if you can grab a long-term bond, muni bond, it's not a bad investment. So I really love the Delaware bonds. First of all, they're general GOs, which I always look for, general obligation bond. But second of all, they usually, if you go shopping and just look at them, and a lot of muni bonds, you get 2.7%, maybe 3%. This one is a 3.7% yield to call and a 3.7% to maturity. So you're basically getting 3.7% tax-free in the United States. That's a pretty good yield for a state that I feel is very reliable. I mean, Delaware is a growing population, very well rated. I will not touch a lot of states in the United States, but there's many that I would, and that's one of them. And so I thought it was a great deal. I bought a little bit, then I bought a little more, and it is of course subject to fluctuations, but 3.7% is a good deal for a muni. Of course, the price can go down if interest rates go way, way higher. I don't think they're going tremendously higher, but who knows? The thing about the bond is it's 2043 maturity. So we're talking about a long bond, and 2033 call. But in my IRA, I also like to buy 20 and 30-year treasuries because, again, I think rates are going to zero. They may not. But you know what? In the worst case, if rates go up, I'll take the interest and I'll reinvest it at a higher rate, and any future savings I can make, in my own income and whatever. But it'll be harder if rates go to zero and this market's stagnant in the future, which is probably what will happen. And then, so I'd rather prepare for that. And if rates go up, as I said, I'll just reinvest. So in case it's not available, it's a perfect example of a nice municipal bond to buy. But as of an hour and a half ago, I saw 860,000 still available because it was a big issue or a big sale. So I like it. And next week, I'll go more into Slate Grocery REIT, which I really, as I said, love the company. I've been studying them for years, and I think it's undervalued. Okay, let's have our panel discussion of the week. We're going to have two of them, subject to time, but I think we can get them both in. Number one, hi, Kim. So number one, the question is, if the evidence is very strong, and that's an understatement in a minute, we're going to go into that COVID originated in China, why were there years of government and tech censorship on the issue? So a couple of points of background, and I'm going to have to read some of this because this is so detailed, but it reads like a spy novel. It's unbelievable, but it's all true. And when you hear the end of this, I'm going to miss 101%, if that's possible, that COVID originated in China and that everything was censored about this. So listen to these 9 reasons. Any one of them, you go, what? Really? And there's still people denying it. Number one, the suicide of the Wuhan lab collaborator, Dr. Yusin, a key Chinese scientist who collaborated with the Wuhan Institute, filed for a patent for a COVID vaccine on February 24, 2020, basically before COVID spread around the world, and he's filing for a vaccine. The early timing raised concerns that the unnamed vaccine was in development months or maybe even years before the vaccine before the pandemic became public. Less than 3 months after licensing his patent, Dr. Yusin died under mysterious circumstances, and the Chinese media said he died from falling off the roof of the Wuhan lab. Let me repeat that. The Chinese media said he fell off the roof. Yeah, I believe it. Right. Number 2, Wuhan lab workers were the first COVID patients. So an infected lab worker was most likely patient number 1. And new evidence, some people denied this as and Facebook and Google said it's misinformation, right? New evidence has come out now that verifies that this was true. So patient number 1 happened to work at the Wuhan lab. Number 3, the lab had a detailed plan 1 year before COVID emerged. Scientists at the Wuhan lab submitted a detailed research plan to the U.S. Defense Research Agency, Project Agency, to create a Frankenstein coronavirus. It was supposedly to help future pandemics or maybe for bio, war, whatever it was. This is a year before the outbreak. Number 4, and this alone again, China destroyed all records from the labs. So it's standard practice in labs to keep very detailed records of, all their work, of their, the studies, the progress. China went in and destroyed everything. Also, if that's not enough, China had reported the sequences of their coronaviruses that they had developed to the National Institute of Health, Dr. Fauci, who is behind a lot of this cover-up. So the Wuhan lab then requested that the NIH delete the sequences, and they did it. Unbelievable. It's like that was the proof, but they deleted it, and NIH went along with it. Number 5, some top virologists had told Anthony Fauci that it came from a lab. So on January 27, 2020, Dr. Fauci called an emergency meeting when COVID was just coming out, and at that meeting, 3 different virologists said that they believed it came from the Wuhan lab. So instead of saying maybe it did, Dr. Fauci and all the group reached this consensus that nobody would write a paper at all that it said that it came from the lab. And if you did write anything about the origin, you would be fueling the conspiracy theory. Even though 3 people at the meeting said they thought it did come from the lab. It's like, you can't even say it. Right. Number 7, China arrested the first doctors who treated COVID. So there was a doctor, I'm saying it right, Wing Lang, and he's most likely the doctor who cared for the first infected lab workers, because a bunch of lab workers got COVID very early. What a coincidence. So then he sounded the alarm on human transaction. Soon after, Lee contracted COVID himself, even though he was only 34-year-old and was of low risk, and he died. And there were conflicting reports about the cause of his death on Chinese media. Again, spy novel, really happened, but all this happened. Next, the lab is 5 miles from the world epicenter of COVID. Like, what a coincidence, right next door. So when you take these 9 things together, the cover-ups, not only did China originate the coronavirus, but the United States helped fund it. And the National Institute of Health, Dr. Fauci, who was in charge of the information on it. So only a few other background things. Number 2, we definitely know that tech and government censored a lot of opinions about COVID because people weren't allowed to say it. They got thrown off social media if you said the wrong thing. And finally, right now, there's a lawsuit in that claims, and a judge has said that he will not dismiss these claims. So he thinks there's validity to it. The lawsuit claims the FBI, the State Department's Global Engagement Center, and the Department of Homeland Security, we're not just talking about one party here, cybersecurity agency, colluded with social media platforms in, quote, hundreds of meetings about misinformation and systematically flagged huge quantities of First Amendment protected speech to platforms. So they're not saying, okay, it happened once or twice. They know of hundreds of times the government is meeting with Facebook and Google and saying, this is what we want you to say. So, Kim, what do you think?
They wouldn't have gotten very far with Nick and I if they tried to shut us. But here's the thing. I was working on the Super Bowl project and in and out of Miami at that time back in December. And back in December, going to some of the Super Bowl projects all the way up to the Super Bowl, I constantly heard people from different countries say, oh, there's a virus going around the world, wash your hands really good. And they were then getting antiseptic washes that were selling off the shelves. And this was from December to, February of the 2020 Super Bowl. Right. And I was constantly hearing this. And I even called a friend of mine who should have been familiar with some of the information, and they weren't allowed to speak about it. But, Peter, I'm an engineer, also a research analyst. And to me, all of these things are good, but it's a timeline, right? You need date, time, place, people to establish your history. And in February, now listen to this, in February of 2020, before anyone went crazy in the US about this, right? You guys still didn't know anything about it, but we were already talking about it on Pod TV or IBM TV at the time. But we already had a global panel discussion about it, talking to people in other parts of the world. But my favorite magazine, now you have to remember, you kind of need to do your homework months in advance, right? Yeah. To be able to establish some sort of white paper to publish in the National Geographic. And they did a white paper type article in February of 2018, which means it probably went to February of 2020. I'm sorry. 2020. February of 2020. I'm going to share it. I'm going to share it with you, but listen to me. It had to have been printed and researched way before then to go to even be published, right? Before people. But I try to share this with everybody, and they go, "Oh, you don't know what you're doing." But I can't. I'm not a member right here. But here's an article that this says that this was taken in February 3rd of 2020. It shows a doctor looking at a lung CT scan. And we were talking about, because my first question, I didn't give a hoot about what everybody else wanted to know. about where did it originate. I wanted to know what kind of damage would it do to our body and our lungs, which nobody was talking. All people were talking about was 6 feet apart. No, 3 feet apart. No. Take chlorine. Drink bleach. And I'm sitting here and I'm going, what is the damage done? And let's start there to the human body. I didn't care at the time where it originated, and already the National Geographic had done this article, and this was published, if you can see, February 18th, 2020. Right. So
many people
wherever it started, and there is a lot of news that it started in China. I think, Wuhan was just a distribution. I had a friend who was very, very sick with something that was unknown in the hospital back November to December, almost died. My husband was very sick. I knew a lot of people previous that were in ICUs with an unknown lung attack, which nobody knew at the time. And literally from November of 2019 until February.
Right, but Kim, but the thing is that November doesn't change the Wuhan story. I mean, there's too many.
What is the timelines you have in your data?
What do you do, Kim? None of this.
I'm asking because I'd like to know what is.
I don't know that. I told you some of the dates. I told you some of the dates. We're talking about around the same time when it's just coming out. And China had to be developing this.
March. My coming out is back in November. November timeframe we were documenting.
Okay, we're not going to have time for the second discussion, obviously.
No, we're not. But I agree.
Wait a minute.
It originated in China, whether it originated in Wuhan.
Kim,
I don't know.
You could not look at these 9 factors and deny that there's an extremely high likelihood. But remember, some of the things I talked about was a year before they were developing this. These things were filed with the NIH, the sequences before. It all happened before. And then immediately after, suddenly people start dying who treat the lab workers and everything. The whole thing's a cover up. The whole thing's.
Well, there's a lab in China. There's a lab in China that's all they do is develop vaccines for COVID for livestock and chickens, fowl and livestock. They've been doing this for many, many years. And it is very obvious to me that could have gone afoul. And
you're saying it's a different lab?
It's not the same as Wuhan. No, they have been developing COVID vaccines for a long time.
Either way, let's assume that it was the other lab for this purpose. The main question is, why did tech and why did the government censor opinions? And what's your final comments on that? Because we're running out of time.
I would go to our politicians and ask them. Because they're the only ones who can censor.
Government should never, ever be involved with social media companies. They should never be telling them what's true or false. 2,
I agree.
You're like having a banana republic or a dictatorship. I mean, this is how banana republics and dictatorships and, one-party countries develop. Because if you are controlling information to that extent, then you can control everybody. You control the minds of people, and it's extremely dangerous. And most importantly, this is why we have the Constitution. And the Constitution, the First Amendment, you're supposed to be able to say anything unless with very few exceptions. I mean, this is the established thing. Unless you're yelling fire in a crowded theater, and that was, I guess, the argument. But that's not.
Peter, they didn't stop National Geographic from printing that article in February of 2020. Right. And that article specifically identified COVID-19 and what it does to the human body. So they already knew this was coming.
Right, but yet they shut it up.
Way ahead of time.
Right, but they shut it up. So we're going to run out of time. I'll move this the next week. We were going to discuss what the definition of wealth is based on a very interesting Charles Schwab survey, among other topics. And we'll get more into the Slate Retail REIT and why I think it's one of the better investments that I have other than energy. And I do like bonds because they're safe. So we'll see you next week. As Kim always says, get healthy, get wealthy.
Take care, everyone.